Hey, it's Rick. It's Saturday, January 28th. For the first time in over a year, the risk model has turned blue. It should be green, but bear with me. In all categories. We finally got the 200-day moving average to go flat, and price for both the S&P and the QQQs is now above it. So I'm getting decidedly more bullish, with a little bit of caution, but I think it's time to jump into the pool. For all of you that have been sitting in cash since last April, it's time now to get back into the market if you haven't done so already. I think earlier in November, December, I suggested that maybe a 25% position would be adequate, perhaps even 50. But now, certainly 50%, maybe even as high as 100%, as long as you put in a relatively tight stop, which I'll draw out here in a second. So I'm just going to focus on the weekly chart. This is the S&P 500 on the weekly basis. And from the peak last December, of course, we had this move down. We had a move back up. We had 1 week where it crossed over the 40-week moving average, but that quickly failed, came down. Here we had 2 weeks really above the longer-term moving average, but then that failed, came back down. So we could have been sucked into the market in this period of time, but then quickly got stopped out for a small loss. Wouldn't have got back in again. Here in August, we had 2 closes above the 40-week moving average, which might have got us back in. Although I was doing these videos at that time, and because this downtrend, this moving average was in a downtrend, I would have advised a lot of caution. And sure enough, it failed. And then in the November here, we got above it again, but then it failed. But this time was interesting. It didn't come all the way down and has recovered. And now we've had 2 closes above the 40-week moving average again. So there is some risk here that this could just roll over and head right back down. In which case I would recommend, if we do get into, you're invested, you would have your stop loss underneath the spiders at 373-ish, which is about probably 5% away. Let me just see. Oh, it's 8%. So that's my maximum tolerance for risk. So that sort of fits. So if the market drops 8% from here, unfortunately, we'd be back out again. So that's wouldn't be a good way to start the year, but it wouldn't be the end of the world. Just to get rid of this thing. What I'm really afraid of. Well, let's go. Why I'm more bullish. If you look at the QQQ, which has been really lagging, it's now doing basically the same thing. It came up here, just touched over the 40-week moving average, came down, but didn't take out this low, and has now come back decisively above the 40-week. So that's given me more positive signs. I think a pullback over the next week or 2 is quite probable. So we don't have to rush in and buy on Monday morning. I don't think things are going to get away from us here, so that's quite possible. The other thing that's making me more bullish is if you look at the other indexes, like the mid caps, you see a bit of a different picture. See, the slope down has not been as severe, and then now we have we're into more of a range here, but the trend is starting to trickle up. So that's the mid caps, and then I think the same thing basically for the small caps. Same sort of picture. That this 40-week moving average actually turned flat a couple of months ago, and is now starting to trend up. So beneath the hood, the smaller companies are performing better, and what's really holding back the QQQ and the spiders is the big cat companies. Like Tesla has really been hammered, although they're having a recovery. Apple, Amazon, all of those big names have really been dragging the major indexes down. The Dow Jones has also been decidedly stronger. So it's been riding above the 40-week moving average for some period of time now. So again, that's a flight to safety a little bit, but that's a good sign. It's been holding up there. It hasn't come back down. So all of those factors together caused me to get much more bullish, and so yeah, it's time to start deploying your cash. I always like to look at, I'm always thinking about the downside of things. And the big risk to me right now is not so much inflation, not so much interest rates, not so much the war anymore, but it's this nonsense that potentially is going to go on with respect to the debt ceiling in the US. And I want to pull up the last time we had a major brouhaha around this was in 2011, which would have been the third year of the first term of Barack Obama. And the Republicans started to play some games. And at one time, Moody's, I think it was, downgraded the US debt, and had a significant impact on the market. And we could experience the same or worse this time. So I'm going to pull up here. This is the S&P 500 going back to early 2010, when it was in a nice strong uptrend, and then it's been basing sideways. And then, so I guess in this area here, there was talk about the potential for an impasse regarding raising the debt ceiling. And then somewhere, I don't have all the news from back in those days, but all of a sudden had a precipitous drop, about over 20% in basically, this is a daily chart. So this is, if I switch this to a weekly, yeah, this happened over like 2 weeks. So you can have, and then it bounced a little bit, and then it went down again. So this drop from, again, if you're following the rules, and this is the 40-week moving average, and you got out somewhere up in here, you would have avoided all this carnage and been able to get back in at much, much cheaper prices. So just be wary of this. I'm not panicked over it now. We're going to get lots of advance notice. The market is a future, predicts the future, if you like, or I don't, that's not the right words, but it's forward looking. So we have some time, but we need to be aware of the fact that by sometime May, June, July, August, in that time frame could be a really, really rough one. And if they don't succeed in just agreeing to the debt ceiling raise, God only knows what's going to happen. It could be like really, really bad. So just tuck that on the back of your head. Make sure that you always have your stop losses in place, because we want to avoid this kind of a crash. Now, it recovered in relatively short order, a matter of months, maybe a year. But you know me, if you can avoid all that and all that pain and angst, and just sitting cash and wait and wait and wait, and then jump back in, you're jumping back in at a much lower price, and you just compound your capital from a much better area. So that's my 2 bits for that. Personally, I'm not going to go through my open positions. I have more open positions I've ever had in 2 years. They're all small. I'm about 70% invested all told. My trading account's 100% invested. I haven't gone on margin yet, but it's possible. And all are doing really well. I mean, it's been a pretty good month, but it's not having a significant impact on my account because the position size is so small, as I'm sort of testing the water. So next couple of weeks, if things hold, I will, as I get stopped out of things or I exit positions, I'm going to be significantly stepping up my size and reducing my position, so increase my concentration. So when the gains happen, they're going to have a much better impact on my account. But so far, January's not over yet, but right now my average gain is running 6.5%, and my average loss is only 1.5%. So that's better than 4-to-1 ratio. So if I can, I don't expect to maintain that necessarily, but if I can, using better size, I will be significantly profitable. So that's it for the weekend review. Yeah, any questions as always, don't hesitate to reach out to me. Cheers.